Now, again, going on with avoiding the cons, I want to just give one example of divergences before I move on. Here's another one. Again, you've got that positive divergence, negative divergence. You've got a higher high and a lower low, and you get the signal as the MACD moves sideways and then slightly lower. The stochastic usually has already started setting off. Look at there how we got so many false signals with the stochastic, and it was not until the MACD had actually itself started going lower that we knew we're onto something here. But that's not all. That's one. That's the second thing. And yeah, okay, the RSI is going down as well, but that's my tertiary examination. What it is we're waiting for price confirmation. When we get that signal on the indicators, it's not until we get some price confirmation that we know that the momentum is indeed downwards in the stock. And then whether we enter on a one-day low once we've got the signal or whatever, it doesn't really matter as much as the fact that we got confirmation from the price as the key determinant. So everything should be captured in there. It should make clear sense. The stochastics gives us so many false signals because the MACD is still going up, rising. Now you might say, well, wait a minute. Over here, arguably, the MACD has started going sideways. The stochastic, well, it had started rising, but let's say it was difficult to read and we thought this was going sideways, this has fallen. Well, don't forget, we're looking for price confirmation and we didn't get it. Ugh, if I can draw a straight line for once, whether it's that bar or this, doesn't matter. We didn't get the price confirmation. We didn't get a one-day high, let's say, or a one-day low or a two-day low. So we're protected by a price confirmation. If the price itself doesn't move, we don't take any signals. And then we see it rising anyway, and so we know, well, okay, we missed a bullet there. So it was not until we got this, and that was around here, and that's when we got in. And that's a divergence, giving a higher probability trade. Higher probability than what? Well, by looking at something which isn't a divergence. If you look at this, which isn't a divergence, the MACD is just going slightly lower, and you could say, well, wait a minute, the stochastic is showing some form of divergence. It's made lower highs compared to the price, which has just gone that way. But I'm talking about MACD divergences here as the principal divergence. And what you're going there is, you haven't got one there. All that happens is that the price goes sideways, fizzles a bit, doesn't really do anything. That's why this type of trade is more high probability than just looking at the indicator alone without divergence. Okay, one of the other ways to avoid the problems and the cons with the indicators, corroborate. We're not just going to look at the MACD and just the stochastic and the RSI, but let's see if we can get corroboration from other things like Japanese candlesticks. These are different ways to depict price charts. For those who aren't familiar, you either have white candlesticks or black candlesticks, and the way they work is this. That as before is the high, that as before is the low. If it's a black candlestick, it means the price has gone down, so it means that is the open and that is the close. So the price has gone down from the open to the close, and then you fill the body up with black to show that. Equally, on a white candlestick, that still is the low and that still is the high, but what it means is the open is here and the close is above it. In other words, the price has gone up, and that's why it's painted white. Yep. Now, the point with candlesticks and how it corroborates technical indicators is this. Certain candlesticks combinations have certain patterns, and it's been shown that following certain patterns occurring, prices tend to move 70% of the time in a certain way. So for instance, following a falling window, which is where you've got a gap, the price falls and you've got a gap between these two, it suggests bearishness. You can see some confirmation there on, if I can draw this properly, on the MACD as well, and indeed the next day you get that, and hopefully if we were spread betting or whatever, CFD trading, we would have captured some of that move and so forth, but we got independent confirmation of what was happening with the MACD and the stochastic from something like that. Now, the point with these is broader one, which is we're looking for corroboration, we're looking for as much independent evidence as possible that what we think is the case is indeed the case. So that's the first point I wanted to make. Beyond that, I don't want to go too much into Japanese candlesticks here. There's a whole CD-ROM set based upon them, but just wanted to let you know they exist and they give us independent corroboration of what else is going on with momentum indicators and help us with our downward momentum or upward momentum trades.